what is Warren Buffett famous quote, right? Be greedy when others are fearful and be fearful when others are greedy, right? And this is exactly what we're talking about. You don't want to capitulate and make a bad emotional decision.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, next up on the agenda in our never-ending quest to educate our clients and the general public about all things retirement, we have another screening of the movie Psychology of Retirement. This one will be at the Edgewood Cinema in Lincoln, Monday, April 21st at 6:30. Give us a quick review again of what this movie is.
Again, it's just a great documentary we helped finance that is narrated by Morgan Housel, who's New York Times bestseller. He's got a couple of them. His book's called The Psychology of Money, which is a great book to hand to recent college grads or anybody that wants to understand, how wealth is accumulated in this country over the long haul. But he does a great job just kind of navigating what the prospects look like of having a successful retirement, and actually interviews 6 or 7 real baby boomers with varying degrees of understanding and asset levels and what they're feeling, the stresses that they're feeling. So it's a really good educational movie. There's no pitch, there's nothing there, and it's complimentary. So if you haven't got a chance to see it, go see it.
Now, if you're in Omaha, you're welcome to join us in Lincoln, but we will be showing this several more times in Omaha as well as Lincoln over the course of 2025. But especially for you in Lincoln, Monday, April 21st, 6:30 p.m. at the Edgewood Cinema. We'd love to see you there. Make sure you register online or give us a call, 402-369-7777. And then, David, we've mentioned this in passing. Let's land a little longer here on this, because this is a brand new class that we're offering. It's Exit and Tax Planning for Entrepreneurs. You often describe yourself as a serial entrepreneur. So what is the purpose of this class?
So this is proactive tax planning for business owners that plan on staying in their business for the foreseeable future. But it's also exit planning in the sense that when we talk about exit planning, and myself, Evan, who is on the show often,
Evan Marshall of Tax Smart, one of our divisions,
who's a CPA, and Mike Schudel, all three of us earned last year a designation called Certified Exit Planning Advisor. And it's not just for the actual exit, Chip. When we talk about exit planning, the reality is you don't know when the exit's coming. Sometimes it's forced upon people. Death, disability, the economy goes down, bankruptcies even happen to business owners. We want to help business owners proactively plan so that no matter when they're going to sell, whether it's their choice or someone else's, or the economy in general, they have the best plan of action. And then we want to help them with proactive tax planning now and through the exit so that they don't pay, give up the lion's share of the gains from their life's work to the tax man, or even overpaying during the current year, which literally 99% of all entrepreneurs are overpaying taxes they're required to pay because no one stops and do the proactive tax planning. And over 4 out of 10 business owners we consult with are operating, Chip, in the completely wrong entity, wrong structure for the type of business they're in, and they have no idea why. And it's because someone just told them, hey, be a corporation or be a partnership, with no understanding of the differences and so if you're an entrepreneur out there and you're running a business, this is a class you definitely want to come to. This is a Saturday morning, so it's convenient. We understand the busy life of entrepreneurs at 8 a.m., and I think we're serving breakfast.
Well, breakfast, Saturday, April 26th. Saturday morning, April 26th, 8 a.m., light breakfast provided. Exit and Tax Planning for Entrepreneurs. Again, it's like all of our offerings. There's no charge, there's no obligation, but you do need to register. You can do that online at retiresmartnow.com or by giving us a call, 402-369-7777. All right, David, into the news, and of course the news being dominated by, I've heard you use the term, there are tariff tantrums going on all over the place. Actually, a little comic relief first. Of course, the tariffs have created some market volatility. And when the Philadelphia Eagles won the Super Bowl, you trotted out a chart of, these Philly teams. This is going back to when the Athletics, the A's, were in Philadelphia.
Got 100 years of data here, right?
1930s, well, a century ago. But the poor Athletics, the A's, you hung the Great Depression on them. You said, well, look what happened after they won the World Series in 1929 and 1930. And then in more recent times, the Phillies, another Philadelphia baseball team, World Series victories followed by downturns in the market. The Eagles in 2018, and now the Eagles this year. And of course, the markets have taken a tumble recently. I don't think we can hang that put all of that on Philadelphia's tab.
No, it is kind of fun though, because the city of brotherly love likes to beat up everybody else, right? Their fans are known to get a little rowdy, and boy, they seem to beat the economy up when they go win. Yeah. And again, in all honesty, obviously, this is not causation. Correlation is not causation, right? But it is kind of ironic that this seems to happen. So, if you're a betting man, maybe the next time Philadelphia is in the championship game for any major sport, look out below.
All right. Let's move into more serious territory now, and we've got a lot of news items to plow through here. Actually, you sent the team a chart. And I've never seen a chart like this before, measuring bearish sentiment. Before I turn this over to you, I'm going to pull the curtain back just a bit here, David, and let people see or hear our process, because in connection with this chart, with this graph, you sent our team a message. I'm quoting your message here. This is why active management works. This is where we earn our fees. So we're not sitting here paralyzed with fear at Retire Smart because of what's happening in the markets. We're working it. So, David, tell us about this chart on bearish sentiment.
Well, let's just talk. Obviously, the overall markets are in bear market territory now. So we've had some serious volatility in the markets. But a financial advisor, in fact, it's in Morgan Housel, who is the narrator of the movie, The Psychology of Retirement. In his book, The Psychology of Money, he talks about that, and he gives a keynote that financial advisors across the country, this is where you earn your keep, keeping people invested in a diversified, risk-allocated portfolio through market turmoil times versus letting someone's emotion capitulate and they just, I can't take it anymore, and they get to the sidelines. I mean, we met with a client that had about $1 million when they got out of the market. It was closer to $2 million in 2008, 2009, and they never got back in. Over a decade of just too nervous to ever put their assets back.
But you missed
they missed the biggest bull market in history.
Yeah. Oh, gosh.
Because you need someone to give you guidance, et cetera. So one of the things we track for guidance, though, is sentiment, right? And I honestly, Chip, it's contrarian, though. So what the chart we have showing there is the AAII sentiment. So that's the American Association of Institutional Investors. So what is the sentiment of professional investors? And it's over 60 of bearish sentiment. That's the third highest in history on the graph that I've given you there. That's only happened 3 times in the last 30 years, right? That's usually a good time if you're a long-term buyer to be buying these things that other people are selling. And what is Warren Buffett famous quote, right? Be greedy when others are fearful and be fearful when others are greedy, right? And this is exactly what we're talking about. You don't want to capitulate and make a bad emotional decision. We had all the advisors send out a video to the clients this past week, and I was in the video as well, just pointing out some charts and things like that. But we're proactive in our management. We're never 100%, hey, you got to be 100% in stocks. And we see people come in all the time that they own 5 or 6 stocks because they watch somebody like Jim Cramer on TV and think that's a diversified portfolio. It is not. The great Ray Dalio, who's famous for starting Bridgewater Associates, most successful.
We quote him frequently on this show.
Hedge fund of all time. He talks about you should be diversified in 5 to 8 different investment ideas or themes or strategies simultaneously, and you overall it's in his book, you'll reduce your overall risk by about 80%. It is so true. You have non-correlated returns. So real estate does differently than commodities, does differently than currencies, does differently than stocks, than bonds, et cetera, at all different times in the economy. So that's why a diversified portfolio will help you win over time. And so most of our clients are going to be diversified in things that are principally protected. They're going to have things that are safe. They're going to have things that are more risky, et cetera. If you don't understand that, or your advisor has not explained how your allocation works, it may be time to call somebody. And again, certainly we'd love for you to call here, but you need to make sure you are comfortable with the allocation your current advisory team is setting you up in. You risk allocation, and then of course we take it one step further, Chip, and show you how to tax allocate that, which adds to the optimization of your portfolio, more take-home pay, more income for retirement, et cetera.
David, you just made a reference to bear market territory. 20% drop, is that how we define
correct.
A bear market?
Yep.
Josh Brown, who's a wealth management advisor, is quoted CNBC, says a classic bear market bounce. He was talking about Tuesday morning, the markets had a rally. Now, my understanding is by the end of the day, Tuesday, that had dissipated. But that bounce was encouraging to some for a while, but it may get worse before it gets better.
Yeah, typically the market doesn't go down in a straight line, right? And so typically when we have a violent sell-off as we've had thus far, you typically going to have a rebound, and sometimes that rebound can be about 50% of the drawdown. So you can see that regularly so if the market drops, say 25%, you could see it go all the way back to where it was only down about 12% and still then make another leg lower. It did this in the last several bear markets. That is commonplace. So it's not usually over just in one fell swoop. And on Twitter, there's a couple of commentators that have issue with, they call him Downtown Josh Brown on CNBC. His handle's the Reform Broker, but he runs Right Holtz. It's a very large registered investment advisory firm, and he's a decent guy. But they call him Drawdown Brown now. In other words, because their advice typically seems to be just hang in there, just hang in there, just hang in there. And so if your advisor is just telling you just hang in there, well, we're going to tell you to hang in there if you have a plan. If you don't know the plan and you don't have a diversified allocation, hanging in there may be tougher than it needs to be. Again, that's understanding where and how to have your assets allocated across a true diversity, non-correlated investments and asset classes.
David, you often remind us that the bond market is massively larger than the stock market. Here's a Yahoo Finance headline: Investors grapple with bond chaos in aftermath of President Trump's Liberation Day. What's happening in the bond markets?
Well, so the bond market has been in a downtrend for the last several months. However, in the recent just week, we've seen a reversal in yields. And in fact, we saw something earlier this week. I believe it was Monday. You saw bond yields go from on the 10-year Treasury negative 13 on the day to a positive like 13. That's only happened 3 times in history. That's a massive move in one day for it to be negative that big, double-digit basis points, and go positive.
That doesn't happen in the bond markets.
No, and so what happens is, remember, when yields are going up, bond prices are going down. So that means people are losing money if they own the bonds, if they sell them, of course. If you hold it to maturity, you're not. But so we've seen a massive rally back up in yields, which means bonds are losing money. So what's going on? Some people are like, China's dumping all their bonds. And I don't have it for this week, but next week I will have a chart up showing you who actually owns U.S. Treasuries. And China is not the largest. People think, oh, China owns all our debt. They're not even in the top 3, okay? Japan owns more of our debt than China, believe it or not, a much smaller nation. But China owns less than $760 billion of U.S. Treasuries. They're not even close to $1 trillion. But anyway, that's for another story for another day. For today, I just want to focus on understanding why are the yields skyrocketing. Well, you have something unwinding in the hedge fund space right now where they are getting clobbered. And because they made a very large leveraged bet, as hedge funds will do. Ironically, hedge funds don't hedge, Chip. They lever. They're just the opposite of hedging, okay? So what they're doing is they bought U.S. Treasuries, and then they short the U.S. Treasury in the future market using the Treasury as collateral, and they can leverage that. You can go up to 200 times in the future market. Now, their average is like 21 times leverage. So if they bought $100 billion of Treasuries, they can lever that up to $2 trillion of Treasury shorting. And when the yields went up, those futures, they lost money, and they had to cover. And to cover, they have to sell those Treasuries at the open market because there's margin calls coming all over the place. That is what put the selling pressure on Treasury, at least what I've uncovered thus far this week. And that's why yields went basically from, we were at 3.9 last week to 4.5 as of Wednesday's opening. That's a massive, massive move in the yield. But it doesn't mean the overall trend down on yields is over. But again, this is where speculators are getting, handed to them versus long-term investors. You need to understand the difference. Are you a trader? Or are you an investor? I have a very good friend who's a trader, but he likes to talk to me like he's an investor. I'm like, you've never owned anything more than 3 weeks in your life. You are not an investor. So stop joking like you are. But you need to understand the difference of how you're making decisions. And I can't say this enough, Chip. People are making long-term decisions with short-term data, and that's bad, right? You should correlate what the data is to the decision and the time frame when you're making these important decisions.
I want to squeeze in 2 more items quickly, David, mostly because you thought it was important enough to share with everybody. One is from CNBC, a story headlined, Walmart scraps quarterly operating income forecast, citing Trump's tariffs. What is the significance of this move by Walmart?
That's just telling you that corporations don't know. They don't know what to make of this. They don't know when this will be solved, et cetera. And again, We can do a whole segment on the tariffs and are they right or wrong. And again, I'm not here to say they're right or wrong. We're here to react in real time with our portfolios and our risk management for our clients. But this is scary if CEOs of the largest corporations in the world cannot forecast what's going on. We like certainty, right? The markets like certainty. We talk about it all the time in tax policy. Well, they want it in tariff policy. They want to know, can we afford to import it? So if they just pause, that's obviously going to slow down revenue growth for them in the near term, which the likelihoods of recession just keeps popping up all across Wall Street in their predictions.
We may entitle this segment The Psychology of Tariffs. And one more quick shot here. China losing trade war standoff. You sent the team a chart showing what has been happening in China as Trump literally, I guess, doubles down on tariff pain for China. What do you see here?
Well, so what I sent the chart is the devaluing of their currency. So China can either say, okay, we give in. That's answer one. Two, they can devalue their currency, which is what they're doing right now to fight back. But that's massively problem for them. Or they can print about $3 trillion of new stimulus after all the stimulus they've had to prop their economy up. Their real estate is in shambles. We've talked about that many times over the last 2 years. China is weak, very weak. Americans consume 36.1% of all products and services sold on the globe. We're 4% of the population.
But just
we're
over
36% of all consumption. So who is China? Can't just, well, we're going to sell this stuff to Europe and Canada. Good luck with that.
No, you need
Canada
us.
only has 40 million people in the entire country.
You need our market.
They need us way more than we need them. Again, I don't like the rhetoric and I don't like the volatility created by this stance, but Trump has got the upper hand in this negotiation. Now, we're going to see what happens here ultimately, and I'm not choosing sides. I'm just telling you, China is in a weak position, and so now it's a standoff, right? I would say Mexican standoff, but now this is a Chinese standoff, and we're going to find out who's going to capitulate first, and we'll report back to you soon.
Financial advisor Alex Murray is one of the rising stars at Retire Smart. We hear from him next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. At Retire Smart, we are building a long-term, top-quality team for the families we serve. That means developing young talent. David, please welcome to the show financial advisor Alex Murray.
Yeah, thank you, Chip. So in the studio, once again, we have Alex Murray, certified financial planner, and also IRMA certified planner. Hey, first off, thanks for stepping in the studio this week. Welcome back. But how did the first IRMA class go? And remind everybody what IRMA is, what the heck we're talking about.
Yep. IRMA is those Medicare penalties, so it stands for Income-Related Monthly Adjustment Amount. And so first class went really well, good success. I think as we walk through some of the scenarios, a lot of people, different people were surprised on if they could actually be affected by it or not.
Well, I think the stats are alarming in that regard. That I think 8.4 million people got letters this past November. I believe that's the right number, but I believe it's 74% of all retirees will at some point in their life hit one of those IRMA or Medicare penalties, and there's 5 different lines they can hit?
Yep, not only that, but if we lose a spouse, then a lot of people get more dramatically impacted by that as well.
Well, that's why planning matters, and you can get a plan ahead of the curve and stay ahead of that. Speaking of having a good plan, a little bit of volatile times in the marketplace Absolutely. Right now. We've been talking about, obviously, we have the tariff tantrum going on, as we call it, in the markets right now. But sometimes people, they'll watch the news or they'll scour the internet. And there's, let's just say there's some creative advice out there these days.
Very creative advice, yeah. So I got a couple here for you just to get your take on them. So the first one was a gentleman online claiming he could write his dog off if he considered it a guard dog. So he could write the food and the bathing and things off on his tax return.
So let's talk about this for a minute. So this is where people get themselves into harm's way and get themselves in trouble by watching somebody with no credentials post a video. Oh, you could do this or you can do that. You remind me of another one to talk about a Rolex watch a young kid posted on how he got his Rolex for free. He committed fraud. But anyway, so people give advice on things they know nothing about. So the IRS lets you write off reasonable and customary expenses as a business owner. Again, we talked about the new business owner proactive tax planning class earlier in the show with Chip. I would highly encourage you, if you're an entrepreneur, to pay attention and come to that class. But this is the kind of stuff that gets you in trouble. You can absolutely not write off your guard dog just because you call him a guard dog. dog. You
Yeah,
can't
I don't
even,
think
you know-
Risen would count as a guard dog.
Yeah,
little
you're
fluffy
exactly
white
right.
Risen.
That Risen is my dog that we actually got on Easter 5 years ago. So Easter Sunday coming up here. So, but anyway, yeah. So that's bad advice. Now, the one I was talking about was a young kid went into the store, got a credit card, went to the store and bought a Rolex watch, and then he's given this TikTok video bragging, I got this watch, and now I'm not going to pay my credit card bill, and they're going to charge it off because it's just a signature loan. I'm like, that's called fraud, and he just did it on camera. What else did you find out there?
The next one was a gentleman saying that you need to put all your assets in a revocable living trust and never pass your house via the will. Otherwise, your kids will not get the step up in cost basis, causing them to pay a large capital gain potentially on the house.
Again, that's utter nonsense. Now, there are certain advantages to placing assets like your home, if it's paid off, into a revocable trust. That's simply so that you can keep your affairs private, typically, though. It could be some asset protection in there, but it has nothing to do with the tax ability of what's called stepped-up cost basis. You could have it in your name. You could have it in a trust. Here in Nebraska, you can do what's called TODD, transfer on death deed. All receive a stepped-up cost basis when the asset passes to your kids, at least under current law. So again, this is scary how much of this stuff, and you did this in short order, found
Yes,
these things.
this is it didn't take very long for me to get this
right?
list.
So,
Yes.
well, even famous people, right? So Dave Ramsey, in full disclosure, I've taught a course called Financial Peace for my church in the past, and it's great to help people. He's done a great job, a great service to a lot of folks, get them to understand the importance of controlling your debt, getting out of debt, et cetera. However, he holds no licensing whatsoever, and he'll make recommendations on things like life insurance, investments, all the time on his show. In fact, last year, the whole CFP board kind of got up in arms because he said, oh, yeah, you could take, 12% distributions out of your account and have no worries?
Yeah. The distribution rate was a little high. I don't know that math would make a ton of sense.
Well, in fact, if you
especially for
retired 20
retirees.
years ago and did that, you would have ran out of money in 14 years. We actually ran the numbers on that. So don't pay attention to Mr. Ramsey. He's a multi tens of millionaire. So at least when it comes to that, get competent advice, whatever you're doing. So just talk about the importance of a real plan. Like we call it a smart plan, but even if it's not here, you should have a holistic plan that covers all the different areas of that are going to be important to a successful retirement.
Yep, all the key areas are important to have somebody in your corner that you can rely on. And I think one of the places where a lot of our advisors provide the most value for some of our clients is in a lot of those transactions, and where they're calling in and saying, "Hey, Alex, I'm buying a car," or "Hey, Alex, I want to buy this house. How can we do that most efficiently?" Because a lot of times that we can help them accomplish their goal, but how they want to go about doing it may not be the best way for them to accomplish their goals.
Well, I've often told clients over the years, I can't promise you I can make you the most money. I can't promise you I can pick every of the correct investments, but we can build a diversified portfolio. But what I can tell you with certainty is if you do need to access capital, I can tell you the most efficient place to go get it. And there's 3 different buckets, if you will, when it comes to taxation of your assets. Typically, you have tax deferred, where the bulk of Americans save their money, the 401k, the IRA, et cetera. You have taxable accounts where it's just that revocable trust or a joint account, whether it's a stock account or checking account. And then you could also just own assets there, and you would pay a different type of tax, potentially like a long-term capital gain versus an income tax on those. And then you have tax-free assets, and there's myriads of ways to use tax-free assets. Most familiar is going to be the Roth IRA, but there's a lot more that people don't realize. So you're exactly right. People need to know that when they want to make what I call a life-changing decision, we're not talking about spending $1,500, but you're going to spend $50,000. You should probably counsel with your financial advisory team on, hey, where am I getting this from the right place? Am I taking, and I can give you an instance. We had somebody retired from the federal government, and a lot of people don't realize there's what's called the Rule of 55. Well, you can access your retirement accounts like the TSP after 55 if you're retired without paying a 10% penalty. You don't have to wait till you're 59 and a half. And this person didn't know this, and they were actually going to take money from another account, or they were going to take money from this account, pay taxes plus 10% penalty. It was going to be over a 45% hit. And I'm like, you don't have to do that. One, you don't have 10% over here. They had an IRA and the TSP. I was like, the IRA had the 10% penalty. That's where they're going to grab the money. TSP did not. But then I also showed them, hey, you have equity in your home, and interest rates were a little lower when this happened, like 2.5%. So we went and got them a HELOC, a home equity line of credit set up on their house. They took out the 50 grand, borrowed it at 2% tax-free,
Yep.
and simply waited the 18 months until they were able to access those dollars without any penalties, et cetera. So you don't know what you don't know. This is why you have to have an advisory team guiding you.
Yep. And a final bit for you I got here. It's actually from one of Dave's personalities, and the tweet was
Dave Ramsey's personalities.
Yep, the S&P 500 is still up over 80% in the past 5 years.
And that is true. So again, people, when the markets draw down like they do now, sometimes people panic. We see what we call capitulation selling. They get really nervous. In fact, we just sent a video out. We had each of the advisors send a video out to all of the clients to kind of, hey, you have a plan. The plan is put in place. The plan was built for a reason. It was built to sustain even this type of market action. Again, this is the 7th bear market of my career. They don't happen that often, but now this is the 5th bear market in just the last 4 or 5 years. So that's a little bit more often than we have them. We had some COVID drawdowns, 2022, et cetera. Again, a bear market's when the major industry draws down 20%. We had that happen to the NASDAQ and the S&P already this year, and the Dow probably soon to follow. We'll see. But don't panic. Have a plan. Understand what your assets are allocated in. And I always tell people, if you're not sleeping at night, then your asset allocation is incorrect. You should probably have that conversation. And one of the things they can do is sit down with someone like Alex here and go through a simple, we have a risk tool, by the way. You can use complimentary. You don't have to come see us. Just reach out to the show here, and we'd be happy to get that in your hands so you can find out what your drawdown is, what's your risk score, what's the likelihood that your assets could fall past your comfort zone. Those are great things to do.
Yep, and it's time in the market, not timing the market, and just having a plan and knowing that you're confident in your plan so that we don't have that, what you call the capitulation selling.
Well, and with the market down 20%, it's a great time to actually buy longer-term assets. Now, again, we don't think the carnage is necessarily over, but if I were your age, every dollar I could scrape up, I would be funneling into my retirement accounts. And if you're pledging dollars through a 401k or 403b, we recommend
to increase those contributions.
Increase your contribution a little bit. If you're putting away 10%, maybe go online today and up that to 12 or 13%. You'd be amazed what that compounding effect will have when the markets are discounted like they are on a long-term compounded rate of return. It's absolutely incredible. Hey, the time is flying here. We got a class coming up with you in the summer, but you're going to be back to talk about that before
I'll be
the
back
class.
to talk about IRMA before then. So
very good. Well, thank you for stepping in the studio this week. Have a blessed week, and we'll talk to you next time.
Thanks for having me.
All right, Chip, what's next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question, well, this is about weathering the storm. I've heard you joke about your wife's investment strategy, Melissa's mattress money. Stuff it all under the mattress so you know it won't be wiped out by volatility in financial markets. That's starting to look pretty good to me. Can you talk me out of it?
Well, if you'll listen to logic and reason, absolutely. If you're going to let emotion run your decision-making, I don't know. My wife gets emotional when it comes to that, and certainly Melissa's mattress money is winning the war this year, right? That's a reality. But here's the thing. The markets have entered bear market territory, Chip. Never in history, if you invested during a 20% drawdown, 3 years later, did you not have a positive return on your dollars?
Well, this is part of your advantage. This is not your first rodeo. You've been through bear markets before,
multiple,
so you
yes.
know we will come out the other side eventually.
Now, again, you should certainly adjust your portfolio and so that you understand the amount of risk you're taking, what's the probability of a further drawdown, and we can calculate that for you, by the way. If you show us what you own, we can show you what the probability is if certain things happen. Interest rates go up, if interest rates go down, if the tariff war continues. We can model these things out, but over the long haul, you're better off staying invested, because if you just stick the money under the mattress, you're losing out to taxation and inflation, right? So you have to get a real rate of return consistently over time, and that means you got to beat taxes and inflation or your purchasing power. The money's just a tool. It really just buys you stuff. The dollar has eroded, and since 1980, you're down to about 36 cents on the dollar, purchasing power of a dollar. If you stuck a dollar under the mattress in 1980, it's only worth 36 cents today. At least that's what it'll buy you. So you really need to have your dollars growing in a way that will keep up with inflation, et cetera.
Weren't you talking in the first segment of this show, David, about a client who took something like $1 million out of play
And sat in a money market account for years.
Worth of gains.
And while interest rate and money markets are up today, so you can get around 4% on a CD or a money market, et cetera. In fact, we have a unlimited money market. I think it's paying 3.85 today, up to $5 million FDIC insured if you need that. But it wasn't that way, Chip. For the bulk of the last 15 years, you were getting less than 1% on that cash. It paid nothing because the Fed kept interest rates artificially low for such a long time. So not only did you not get a return, you paid tax on what little return you did get. And by the way, if you were retired and getting Social Security, that interest now made your Social Security get taxed as well. And again, people don't know these things.
Don't panic. We're here for you. All right. Next question, David. This one's about, we get several species of this questions over the course of a year, whether to pay off a mortgage. I'm getting about $200,000 from my divorce. All of this money will be in an after-tax account, not an IRA. So I'm very tempted to just pay off my house with the money. I'm 50 years old and still have 22 years left on the mortgage. Paying it off seems appealing, but that would almost completely wipe out the account. Though I'd still have my 401k with about $300,000 in it. What do you think I should do?
Well, there's a few things to calculate in there, but in general, okay, your house is an appreciating asset, right? Now, it may not go up this year in value, but your house is typically going to go up 3 to 4% a year in value consistently over time. And look, we got 150 years of data to back that up, Chip. So if your house was, say, worth $300,000 today, 20 years from now, it will be worth $600,000. You owe $200,000 on it. So that is, while I don't like debt, that's good debt. And you can write that interest off if you're itemizing on your tax return. The other thing is if you have $300,000 in your 401k, that's tax deferred. You have to pay tax on these dollars. These $200,000, you're not going to have to pay tax on this money. This is available to you. So you can invest it in a way that you could use. And right now, and I don't know what your interest rate is. It sounds like the mortgage has been in place for a while, but over 75% of all mortgages in place today have interest rates below 4%. So if your interest rate is below 4% and we can guarantee you a 4% in a CD, that's a positive arbitrage. Even if you don't want to put any risk to the money, go put it in something that'll get you 4.5% over the next couple of years. And by the way, we have like 5.1% available for 7 years. It's through what's called a MIGA, a multi-year guaranteed annuity. It's insurance company's almost version of a CD. So there are ways to guarantee returns. Now, the downside of those type of products, full disclosure here, is that you lock that money up. You can't break that like you can a CD, or you'll pay typically like a 10% surrender charge. But you can get higher interest rates guaranteed. So I would not most likely recommend paying it off. However, I paid off a mortgage I had. I think I talked about on the show earlier. We had a $90,000 mortgage. I own several rental properties. They're all debt-free, right? And it drives me nuts. I want leverage on all those properties because I want to go buy more, right, with the leverage. But my wife, as we've talked about, Melissa Mattress, she hates the word debt with anything. So for Christmas, I paid off a $90,000 mortgage we had. That was at like 2.25%, even though I was earning over 4% on the cash and I had plenty of it sitting there. It killed me to do that, but happy wife, happy life, gentlemen. So guess what? For her, and because I have other liquidity,
a paid off mortgage under the tree.
So again, everything is specific to the situation, but we can help you run just the numbers, but emotion matters too. And if you can't sleep at night and you're better off with it, I get it. So, but you are the perfect person to come in for the report card where we can analyze all of this so that you can have an understanding of what you should be doing. And maybe it's a partial mix of both.
Up next, Social Security recipients, your check may increase this month. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, here is the Fox Business headline. Social Security checks will be bigger in April for some retirees. What's going on?
Well, the Fairness Act that was signed into law by Biden is now being implemented. And so people that were had the WEP, the elimination, et cetera, are getting caught up. And so there's some lump sum. We already had clients get it. But the bulk of people are getting checks here in April, depending upon your date of birth, right? Depending on when you're born, there's this checks going out in the like third. So the first 10 days, a tranche will go out in the next 10 days, et cetera. But basically, and checks will increase. So some people are getting lump sum checks, and some people are just getting increases in their Social Security, eliminating that provision. So basically, folks that paid into Social Security, but because they had other guaranteed income from the federal government, and for a time in their career they didn't pay in, they were being penalized, and now they're getting some new money. And so for a lot of people, it's free money coming to them that they weren't expecting. So kudos to you for getting it. We've had several clients that have been affected by this. And so if you need to understand, the only thing I would just point out, Chip, is people need to make sure they understand the tax withholding on those checks that are coming to you. Make sure you've adjusted your withholdings with the Social Security Administration. You can go online and do that so that you have the proper amount withheld.
David, you recently sent the team a chart regarding wider market breadth. Define it for us, explain it for us, and tell us why you thought it was significant enough to share with the team.
Well, wider market breadth is healthy. In other words, when the breadth of the market is like, are all sectors and all companies participating when we have a bull market, right?
Oh, instead of just the Magnificent Seven.
Right, instead of a handful, which we've had for, the last 5 or 6 years. It was FANG for a couple of years, if you remember FANG. So it was just 5 stocks. Then we kind of widened it out to what we called the Magnificent Seven for a few years. But literally the top 10% of companies, or the top 10 companies in the S&P were almost 40% of the index at the start of this year. That's very narrow. Well, we want it to widen out, but you don't want it to widen too far. There's got to be somebody who's losing. All companies can't be, doing great. So when you see the breadth of the market widen out too far, where over 60% of the companies are moving in the same direction, that's actually a bearish signal. So it goes, the pendulum swings too far in the other direction. And that was the chart I sent out showing you, and that was a telltale sign from just a few weeks ago when I sent it out.
That was even before the tariffs took effect.
Correct. That there's something coming, something didn't look right on the horizon. Again, one of the reasons we took a little bit of risk out of several of the portfolios. Again, we read the tea leaves as best we can. We are not the great prognosticators. We're not trying to time the market. We're simply risk allocators. In other words, we take the capital our clients have worked their whole lives for and show them how to asset allocate that on a risk-adjusted basis so that they can get a probable rate of return to enjoy an amazing retirement. And then we want to further show you how to tax allocate those assets so you can actually keep more of it, right?
I just want to keep reminding people, there are options, there are scenarios, even in volatile times like we're in right now. Now, if you have an advisor who's saying, stay the course, that might be a red flag. You might want to at least talk to us or somebody else.
Do you know the plan? And it may be good advice if they actually have done a real job of truly diversifying you. If you're in at least 5 different asset classes, if you have a plan that shows you where your income's coming from, do you understand how far your portfolio could draw down in this type of scenario? Someone has shown you this with math. And even our clients sometimes forget, which is hence why we communicate. We send videos out now, typically about every month or so. We'll send a video out just on broader topics to communicate with our client base so that they know where they are. And again, communication is really important. And in 2009 was probably the biggest year I ever received in referrals early in my career because of the communication I did during 2008 correctly. And again, if some advisors that are scared, they don't know what to do, and they put their head under their desk, and that's that's not what you're paying them for, right? They should be counseling you and helping you understand what's going on. And again, it could be emails, it could be phone calls. And again, advisors are busy. So, they can't call you every day and hold your hand either. Let's be realistic in the amount of communication you'll get. But you should know or feel confidence in the team that you've deployed to help you in these areas.
I guess we preach stay the course to the extent of, as you've said a couple times now on this show, well, don't just panic and disengage and turn everything into cash and just hoard your pile of cash. But within that space of staying involved in the markets, there are a lot of different scenarios. And that's what we do. We'll help you. We'll reposition you to maximum advantage.
Well, to that point, we've had several of our clients call in, hey, got a little extra capital. Is it a good time for me to put it to work? And I literally, before we came in the studio this morning, I had one of the advisors, Kate, got somebody sending in, and it was a dollar amount, and wants to know, should we deploy it right now or should we wait? And I just said, well, I would actually give it the next 2 or 3 weeks, and we'll kind of find out where we are. But as my question is this capital that we're not going to touch for 3 to 5 years, or is this capital they're going to want back in 6 months? Because deploying it would be very different. But if it's a 5-year or longer time horizon, absolutely, you could go buy stock today if you felt like doing it. Now, could you get an absolute optimum better buy? Sure, it's possible. But again, it's understanding when you should be greedy and when you should be fearful. And typically when the market sentiment and the news is one way, you might be looking to go the other, right? Contrarians typically win, especially in times like these.
David, I want to squeeze in one last item here, and this has been somewhat obscured by all the fuss about the tariffs and the fallouts of the tariff tantrums, as you've referenced, and so forth. But this is from Fox News. U.S. federal agencies to unleash coal energy.
Mine, baby, mine.
Yeah, it's in the headline. Mine, baby, mine. You know, there's drill, baby, drill for oil, and now for coal. Mine, baby, mine. President Trump had a press conference. It was more like a pep rally with coal miners. And he says in this article and in numerous other places, he's going to pursue multiple sources of energy to, again, achieve energy independence.
So I don't think people understand just how short we are on energy that we need, which was part of the three-pronged approach that Trump and his administration said going in. We heard Scott Bessert explain this all the way back before Christmas, that they were going to get oil down, which, by the way, as of this recording, is at $55 a barrel, right? So gas prices are down. Treasuries have come down from the election day. They were at 4.72, or inauguration day, et cetera. They come back up some, but they're still down, right? So the cost to borrow and capital is down, et cetera. Obviously, the market prices are down. But we've got to find ways to create energy. China has 5 times the energy, the ability to produce 5x the energy we can produce in this country right now. And with AI, if we want to win in the future of technology and job growth in America, we must win the AI battle. We must have IP, intellectual property, stay here on our shores. But to do that, we're going to need massive server farms. So those of you who live around here, right? I live on the southern side of town. If you go down towards Springfield, you see these massive server farms for Google and Facebook, and they're over in Iowa, and they're building some on the north side of town, right? These are required, and they have an enormous need for energy to run these server farms. So we don't have enough to do that. So we have to get all forms of energy going full force. Coal is an important piece as we transition and hopefully build back a bigger nuclear arsenal of nuclear energy, because that is the cheapest version. Problem is, a nuclear power plant, you can't turn it on tomorrow. But coal, we can fire that up immediately and have results in 90 days. And we need energy, natural gas, coal, and certainly there's room for a little bit of wind and hydro, things like that, but they're not ready for prime time. They are not going to get where we need to go. We must get energy consumption up, or get energy production up, excuse me.
That'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer, including the Psychology of Retirement, including our upcoming Exit and Tax Planning for Entrepreneurs class. There's no charge, there's no obligation for our events, but you need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.